guys, welcome back to In Case of Econ Struggles, and welcome to another AP Micro Struggle. Today I'm going to talk about profit maximization, which is topic 3.4 and 3.5. Now, profit maximization, there's only two things you need to know. The first thing is that there are two types of profit, and we'll go through that relatively quickly because I think that makes a lot of sense. And then as you can see from the font size, the second thing you need to know is that when you're doing profit maximization, marginal revenue is equal to marginal cost. That's the thing you need to learn, live, and love. That's the thing you should get tattooed on your forehead if you're trying to think about what profit maximization is, how to solve a profit maximization problem. Marginal revenue is equal to marginal cost. If you know that, you can solve any profit maximization problem that comes your way. But again, profit maximization, just to reiterate, you're looking for marginal revenue is equal to marginal cost, and that's where we're going to spend the bulk of our time talking about. So timestamps are below if you'd like to jump around, but let's go ahead and get right into it. Like I said, the first thing is the two types of profit. I think this is relatively straightforward, but again, if I go too fast, leave a comment below and I'll try to add an extra explanation. But let's see if this quick example helps you understand what I'm talking about. So there are two types of profit. The first is called accounting profit. Accounting profit is what you might immediately think about when you're asking how much profit does someone make. So for example, here's Deb's Donuts, owned by Deb, and let's say that in a year, Deb's total profit is $50,000. We would say that her accounting profit is $50,000. Okay, but that makes a ton of sense. What in the world could a different type of profit be? Well, the other type of profit in economics is called economic profit. And as you might expect with economics, we're going to be talking about opportunity cost. Remember that opportunity cost is the value of what you could be doing if you're not doing what you're currently doing. So maybe Deb's currently running a donut shop. Maybe Deb could be like Bill. Deb could also own an ice cream store. She doesn't. She owns a donut shop. But when we're trying to think about Deb's economic profit, we need to take into account the cost or the value of Deb being an ice cream shop owner. So she made $50,000. Maybe she could make $25,000 if she was running an ice cream shop instead. So we're just going to subtract out the $25,000 she could be making as an ice cream shop owner, which will take her economic profit to $25,000. So you can see that for Deb, it's still positive. So Deb is still doing better owning a donut shop than an ice cream shop, because if she was owning an ice cream shop, she would only be making $25,000. And so Deb is willing to not be an ice cream shop owner. She's willing to own Deb's Donuts because her economic profit is positive. And if her economic profit is positive, well, her accounting profit is also going to be positive. So again, the assumption here is that Deb is thinking about her economic profit when she decides what she does. And accounting profit is really not something Deb's thinking about. You could debate this, right? Most people probably only think about accounting profit when they're running a business. But you can also imagine Deb sitting at the table at her house and thinking, I own this donut shop. Is it still worth it to me to own this donut shop? You might say that Deb is going to definitely rely on how much money she's making profit-wise. But she might also ask questions like, am I still having fun? Is this worth it? Would I rather be doing something else? And the answer to those questions, when she tries to put a monetary value on those questions, how fun is it? Would I rather be doing something else? She's adding in this opportunity cost, or the value of what she could be doing, her outside option, what else she could be doing if she wasn't running this donut shop. And if she puts all that math together and says that her profit is still positive, then the next year she's going to continue to own and run this Deb's Donuts shop. So those are the two types of profit. And now let's move on to marginal revenue equals marginal cost. Like I said, this is the most important thing for profit maximization. That's why it's literally everywhere. So the way I want to sort of motivate this is, remember that when we did utility maximization, we sort of set the marginal benefit equal to the marginal cost, where the marginal benefit was the marginal utility you got from, say, buying an ice cream cone, and the marginal cost was the price you had to pay for that ice cream cone. And so you set the ratio of marginal benefits equal to the marginal costs, or the ratio of the prices, in order to find your utility maximization. Now in profit, it's the same way, except your marginal cost is actually your marginal cost, and your marginal benefit is just your marginal revenue. So we're just going to set marginal revenue equal to marginal cost, and we're done. Now for the AP exam, you're going to have to do this from both a table and a graph. So let's just take a quick look at both of those options. So here is a lovely table. You might be presented with this in a number of ways, and so I presented it all together. The easiest way is if you're just looking at price, and remember, price is the marginal revenue you get, because that is how much money someone is paying you for an additional unit. So if your ice cream costs $10, every time you sell someone an ice cream, they're going to hand you $10. So the extra revenue you got from that ice cream is exactly the price, or $10. So this is really sort of your marginal revenue. This is your marginal cost, and you can see they're equal right here, which is a quantity of 5. Now, if they don't want to be that nice, they want to ask you a little tougher of a question, they might give you just total revenue and total costs. But if this is total revenue, the change between revenues is going to be your marginal revenue. And you can see here it always changes by 10, which is how you could get this 10 here. The answer to how does your total cost change when you have an additional unit of quantity is just your marginal cost. So the change from 2 to 6 is going to be 4. From 6 to 12 is going to be 6. And you could go all the way through like that and sort of fill in this column. And again, once you filled in this column, you would see that marginal revenue or price is equal to marginal cost at 5 ice creams. If you were to see this on a graph, you might see a horizontal line for the price, or you might see a linear line for, again, total revenue. You're just finding where your marginal cost equals your marginal revenue. So here's your marginal cost. Here's your marginal revenue. They touch at 5. It'll probably be on like a graphical paper of some sort. So you can see they touch at 5. And so again, the answer to this profit maximization problem from this graph is 5. So hopefully this gives you a brief introduction to profit maximization. We'll revisit this later, but this is a basic example. If you still have questions, leave a comment below. But if this was helpful, make sure to like and subscribe, and we will see you next time for another case of econ struggles.